Before we begin our investigation, a quick reminder. All information in this video is for educational purposes only and is not financial advice. The paper castle has fallen. For months, the biggest banks and analysts built a wall around the $65 level. They called it the ceiling, the line in the sand, the final line of defense. But today, physical reality collided with the paper illusion, and the illusion crumbled to dust. The price of silver didn't just touch this level, it burst through it, breaking out with such force that it reached $66.50 before pulling back slightly. I know what you're feeling right now. You're looking at that small pullback from the peak, and deep down, a familiar conditioned fear is creeping in. Was that it? Is this another trap? Another fake-out? I need you to stop and take a deep breath. Because what we are witnessing is not weakness. It is confirmation. Confirmation that the suppression blueprint we've been investigating is entering its final, most violent stage. You are on New Era Economics. In this emergency market update, we will conduct a post-mortem of this historic breakout. I will explain the exact mechanism, the so-called gamma squeeze, that forced banks to panic buy silver against their own will. I will prove why this current pullback is not the top, but the construction of a launch pad for the next leg up. The wall at $65 has fallen, and now our job is to defend the rubble upon which a new, honest market will be built. To understand why the price of silver literally teleported from $64 to $66.50 this morning, my investigation led me to the darkest and most complex part of the financial system, the options market. It was here that I found the weapon that left such a distinct mark. Technically, it's called a gamma squeeze, but in essence, it's a mechanism of financial self-immolation that the banks brought upon themselves. Let me explain this with a simple analogy. Imagine an insurance company. For months, this company has been selling thousands of fire insurance policies to the residents of a town built next to a dry forest. For every policy sold, the company collects a small premium. It's easy money, as long as the forest doesn't burn. In our case, the banks on the COMEX are that insurance company, and the $65 strike call options on silver are their insurance policies. By selling these options, they were essentially betting that the price of silver would never exceed $65. As long as the price was below $65, they collected daily premiums from those betting on a rise. But this morning, the fire started. The price of silver broke through the $65 level. At that exact moment, every insurance policy they had sold flipped from a source of profit to a source of potentially infinite losses. And the risk management computer systems at these banks started screaming, "Mayday!" To avoid going bankrupt from paying out claims, the insurance company is forced to do an illogical thing. It must start fighting the fire itself. It is obligated to send buy orders into the market for sandbags and water, in our case, silver futures. This process is called hedging, and this is where the trap snaps shut. By buying silver futures to hedge their losses, they themselves push the price of silver even higher, say to $65.30. This is like trying to put out a fire with gasoline. The higher the price goes, the bigger their potential losses on the options become, and the more futures their computer is forced to buy to hedge. A higher price leads to more risk. More risk leads to more forced buying. More forced buying leads to an even higher price. This is the gamma squeeze. It is a feedback loop that spirals out of control. It is the exact same mechanic that sent GameStop to the stratosphere in 2021. It has nothing to do with fundamentals in that moment. It is pure, brutal mathematics of a system turning on its creators. That sharp spike to $66.50 this morning was not the sound of joyful buyers. It was the shriek of a panicked algorithm, forced to buy everything in its path to save the bank from ruin. It was a vacuum. For a moment, there were no sellers, only desperate machines programmed to buy at any price. They were caught in a trap of their own making. So the gamma squeeze trap snapped shut, and the price exploded upwards. But why didn't it keep going? Why are we seeing this pullback to, say, $65.80? In my investigations, I've seen this pattern countless times, and it is the most misunderstood moment of any breakout. To the amateur, a drop from $66.50 looks like weakness, like a failure. But to a professional analyst, it looks like confirmation. There is a golden rule in technical analysis that is almost as immutable as the law of gravity. Old resistance must become new support. For months, the $65 level was a concrete ceiling for silver. Every time the price touched it, it was brutally smashed back down. Today, we broke through that ceiling, and now, figuratively speaking, we are standing on top of it. This pullback is not a fall. It is the market cautiously stomping on this new floor, testing it for strength. We need to see that buyers are willing to defend this level, and the evidence I've gathered in the last few hours suggests they are not just willing, they are already doing it. The whale is still here. I have been closely monitoring the real-time order flow. When the price began to pull back from the highs, speculators started taking profits, pushing the price down. But as soon as it approached the $65.75 level, a wall of giant block orders suddenly appeared on the buy side. Someone stepped in and essentially told the market, "I will take everything you are selling at this price." This tells us something critical. The smart money believes that $65 is now cheap. It is no longer a ceiling to be sold. It is a floor to be bought. This is not the behavior of a speculator looking to cash out quickly. This is the behavior of a long-term investor using the panic-induced liquidity to build their position. They are building a base camp at this new altitude, preparing for the next ascent. The shorts are trapped. Every trader who bet against silver, shorted it, below $65, believing the ceiling would hold, is now in a very painful position. They are underwater. Every cent the price rises is another cent added to their losses. They are no longer the hunters, they are the cornered prey. And they have only one way out: to buy back their short positions to stop the bleeding. But how do you close a short position? You have to buy. They become forced buyers. They are now competing to buy silver with Tesla, with that same whale, with all of us. Their panicked buying to cover their losing trades becomes the very fuel needed for the next wave of growth. So, what are we really seeing in this retest? We are not seeing weakness. We are seeing a transfer of silver from weak hands to strong hands. We are seeing the smart money actively defending a new price frontier. And we are seeing the coiling of a new spring, powered by the energy of the trapped bears. The breakout was the initial explosion. This retest is the process of securing the new territory. We've established that the new frontier is being defended and the shorts are trapped. But to understand the true magnitude of what happened today, we must do what Wall Street fears most. We must look at their accounting books and calculate the losses. For decades, the so-called bullion banks have played a very profitable game. They acted as the governor on the engine of silver. When the price rose, they would sell massive amounts of paper contracts, creating an artificial supply and smashing the price down. When the price fell, they would quietly buy those contracts back at a profit. But today, that engine exploded. Like a reporter revealing inside information. To understand the panic reigning in their boardrooms right now, we need to look at a report they themselves are required to provide to regulators, the Commitment of Traders Report. This report shows us who is long and who is short, and the latest data I've analyzed paints a picture of a catastrophe. According to this data, the net short position of the commercial banks was approximately 80,000 contracts. One contract equals 5,000 ounces. Simple math, that is 400 million ounces of silver. 400 million ounces that they have promised to deliver but most likely do not own. They sold it on paper, hoping to buy it back cheaper. They sold it $50. They sold it $55. They sold desperately at $60, trying to hold the line. And today, the price is $65.80. Every single one of those hundreds of millions of ounces is now a losing position. Let's quantify the pain. Markets are driven by pain. For every $1 that the price of silver rises, their combined short position loses roughly $400 million. Since this breakout began at, say, $60, the price is up almost $6 times 400 million. That is $2.4 billion. That's $2.4 billion in paper losses that have materialized in just a few days. But here is the horror of their situation. That's just the tip of the iceberg. That number assumes they can close their positions at the current price. Melancholic for them, triumphant for us. But they can't. If they tried to buy back 400 million ounces right now, what would happen to the price? It wouldn't stay at $65. It would instantly jump to $100. This phenomenon is called slippage. The very act of exiting the trade makes the trade more expensive. So their real loss isn't $2.4 billion. It's potentially 10 or 20 billion. It is a black hole that has suddenly opened up on their balance sheets. This is why the $65 level was so important. It was their Maginot Line. Below this level, their gain was profitable. Above this level, their losses become exponential and, even worse, visible to shareholders and regulators. Above this level, the CEOs of these banks start getting calls from the central bank asking, "Are you still solvent?" We are watching a slow-motion car crash. The banks are trying to exit their short positions gracefully. They are trying to buy them back quietly, in small increments, without spiking the price. But the whale we talked about isn't letting them. It is absorbing all the available supply. So the banks are forced to bid higher and higher to find sellers. This is the dynamic of a short squeeze. It's not just about the price going up. It is about a transfer of wealth from the entities that suppressed the price to the entities that liberated it. The banks are trapped. They are losing billions. They are being forced to buy back their shorts. But while we watch this drama on Wall Street with bated breath, my investigation has led me to conclude that we are all watching the wrong screen. While our attention is glued to the ticker showing $65.80, a far more important process is unfolding in the real world. The great decoupling, which we've spoken about as a future possibility, has already begun. If you're only watching the numbers on the news, you are missing the real story. The price of $65.80 is not the price of silver. It is the price of a paper promise to deliver silver in New York next month. But if you turn off the computer, walk out into the real world, and try to buy a large quantity of physical metal, you enter a completely different reality. In this reality, there exists what I call the shadow price. This is the price paid by those who need the metal not for speculation, but for survival. It's the price Samsung pays to keep its microchip factories running. It's the price the US Mint pays to get the blanks to mint American Eagle coins. And that price, my sources indicate, has not been $65 for a long time. Why would an industrial giant pay, say, $70 an ounce when the screen says $65.80? The answer is simple. Reliability. Imagine you run a solar panel factory that costs $1 million an hour to operate. If you run out of silver paste, the assembly line stops. You lose millions. You call your supplier. They say, I can get you silver at the COMEX price of $65.80, but delivery will take 3 weeks, if we're lucky. Or you can pay $70, and I will ship it from my emergency reserve today. What do? You pay the $70. You pay any premium, because the cost of the metal is nothing compared to the cost of shutting down the factory. This is exactly what is happening right now. We are seeing reports that this premium pricing is cascading throughout the supply chain. The largest electronics consumers are bypassing the exchanges altogether. They are going directly to the mines. They are going directly to the refiners. And they are offering cash bonuses to jump the line. This creates a shadow market. The volume is moving off exchange. It doesn't show up on the COMEX volume bars. It doesn't affect the spot price immediately. But it is vacuuming up the physical inventory at an alarming rate. While the banks are trading paper back and forth to manage the chart, the real silver is disappearing from the market at a much higher price. Eventually, this gap must snap shut. When the COMEX can't find the metal to deliver on even a single contract, the spot price will be forced to gap up to meet the shadow price. That is when you will see a $5 jump in a single morning. We are currently in that gap. The screen is lying. The real-world invoices are telling the truth. Now let's look at the retail market, where you and I buy. Go to any major dealer's website right now. Look at the premiums. Usually, when the spot price rises fast, premiums compress. But today, both spot and premiums are rising simultaneously. Why? Because the dealers are scared they can't restock. They sold you a coin yesterday at $63. Today, to replace that coin on their shelf, they might have to pay $65. They are losing capital. So, they widen the spread. They charge you $65 plus a $10 premium. The ask price becomes $75. They are effectively discouraging you from buying unless you are desperate, exposing the industry practice. Or they switch to pre-order, shipping in 4 weeks. Do you know what that means? It means they don't have the silver. They are taking your money today, hoping they can find the silver in a month. You are giving them an interest-free loan. This inventory squeeze at the retail level is the canary in the coal mine. When the dealers stop selling, it means the wholesalers have stopped selling. And when the wholesalers stop selling, it means the refiners have stopped selling. The supply chain is seizing up. So, we've dissected the breakout, counted the bank losses, and exposed the secret $70 shadow price that industry is paying right now. But now we need to zoom out. It is easy to get lost in the minute-by-minute battle. It is easy to stare at $65.80 and wonder if it will hold for the next 10 minutes. But if you do that, you miss the history being made. The biggest enemy you face right now is not JP Morgan. It is vertigo. When an asset price moves this fast, when it breaks all-time highs and enters blue sky territory, human beings get dizzy. You look at your portfolio. You see green numbers. You see gains that used to take years to achieve happening in days. And your brain screams, "This can't be real. It must crash. Take the money and run." So banks know this. They rely on it. They know that retail investors are weak hands, not because they lack money, but because they lack conviction. So, in the coming days, expect volatility to increase. We might see silver drop $3 in an hour. We might see it rip up $5 the next hour. This is designed to induce motion sickness. They want you to get so stressed out by the swings that you sell just to get a good night's sleep. Do not give them that satisfaction. Volatility is the price of admission for generational wealth. If you sell now at $65.80, where do you go? Do you go back to the dollar? the currency that is guaranteed to lose 5% of its value a year? Do you go to the stock market, which is trading at historic valuations? You have to realize that silver isn't just going up. The dollar is going down. Silver is just the mirror reflecting the collapse of the fiat currency system. Do not sell the lifeboat to buy a ticket back onto the Titanic. But $65 is expensive. I hear this all the time. People think because silver was $20 a few years ago, $65 must be a bubble. Let's look at the data. In 1980, the Hunt brothers squeezed silver to $50 an ounce. That was the all-time high. But $1 in 1980 bought a lot more than $1 today. If you adjust that $50 high for the official CPI inflation rate, that 50 is equivalent to roughly 170 today. Think about that. To simply match the purchasing power of the 1980 high, silver needs to nearly triple from here. At $65, silver is trading at a 60% discount to its inflation-adjusted high. It is the only asset class on the planet that is this cheap. Stocks are at all-time highs. Real estate is at all-time highs. Art is at all-time highs. Silver is still recovering from a 40-year bear market. So when you feel like $65 is too high, remember that math. You are buying the most undervalued asset in human history. We are not at the top. We are barely off the bottom. This perspective is your shield. When the media screams bubble, you look at the inflation math and smile. The bubble isn't in silver. The bubble is in the dollar. This leads to the final question. When do I sell? If we're going to $100 or $170, at what point do you cash out? And here lies the ultimate secret of the wealthy. You almost never sell for cash. Cash is a melting ice cube. You only sell to swap. You swap an asset that has become overvalued for an asset that is undervalued. Right now, silver is extremely undervalued. But one day, at $150 or $200, it might become overvalued relative to other things. What do you watch? Watch the gold-to-silver ratio. Right now, it takes roughly 70 ounces of silver to buy 1 ounce of gold. Historically, that ratio always returns to 40, 30, or even 15 to 1. When it approaches those levels, that is your signal. You swap your volatile silver for stable gold. You've essentially doubled or tripled your gold stack for free without ever touching $1. Or you swap for real estate. In 1980, you could buy the median American home for roughly 800 ounces of silver. Today, at $65, you need roughly 6,000 ounces. Wait for that ratio to close. When you can trade a monster box of silver for a down payment on a farm, that is the exit. Do not trade for numbers on a screen. Trade for acres. Trade for ounces of gold. Trade for cash-flowing assets. That is how you lock in the wealth transfer. We have covered a lot of ground today. The breakout, the gamma squeeze, the bank losses, the physical disconnect, and now the psychology. Wednesday, December 17th, 2025. I believe we will look back on this day as the tipping point. The day the banks lost control. The day the $65 wall fell. The genie is out of the bottle. The world now knows that silver is scarce. They know the price was suppressed, and they are rushing to get a seat at the table. You are already seated. You saw this coming when everyone else was asleep. Now, your job is simple. Do not move. Do not sell. Let the market come to you. The squeeze has just begun.